everybody. Excited to be on here today. Just about 4 weeks left in this year, and we're in the thick of tax planning with our clients, making a lot of decisions here at year end, doing a ton of deliverables, especially as it relates to comparative analysis on tax planning. So, wanted to continue adding value to you guys here by bringing to you what we see with our clients, especially as it relates to questions we get asked during the tax planning periods, especially Q4, but frankly, just all throughout the year. These are very common questions that we get asked. So I figured what better way for us to add value, basically go through and pull out all of the questions that I see come through my inbox, also questions that come through either emails or during planning calls, and go through them and start to answer, not necessarily in order of priority, but just from a perspective of most commonly asked questions. So let's go ahead and get started. We'll kick it off. It's week 5. I plan on doing, I would say, a couple more weeks of these lives before we hit Christmas, and then we will see where we land. We'll probably go back to some CFO level discussions, but give me some feedback on this. If you guys like this type of content, let me know and we'll continue providing value to you guys. So, like I said, I'm going to clear up a lot of noise and confusing feedback that I see from clients who might go to ChatGPT and type in some questions they have, and they come to planning calls and say, hey, I read somewhere about this, this, and this. What do you think? So I'm going to keep my responses crisp and short and direct. Is there gray areas in tax planning? Absolutely. We like gray areas in tax planning because that's where planning happens. But also on some of this stuff, the answers are pretty black and white on what IRC code sections say about specific stances, built-in gains, cost segregation studies, capital losses, capital gains, just things of that nature. What makes sense to buy from a vehicle perspective? Should we buy a heavy vehicle? Should we wait till the following tax year? Certainly questions around should you do it as a tax planning strategy. But if the question is, what does IRC code section say about certain things? That is relatively clear. So the first one I want to tackle here, the first question is, can rental losses offset my W-2 income? Very common question, especially from those who are in the high income earning brackets. So think, 250K plus, 300K plus, oftentimes husband-wife partnerships, husband-wife teams, let's say, not necessarily partnerships from a tax perspective. And the question is, I read somewhere I can buy a short-term rental, so I bought it. And I was, my understanding was I can take losses from my short-term rental against all of my income. But then I talked to my CPA and they're saying, no, you can't do that because you don't meet reps. Like, I don't understand. How am I supposed to deal with this? I'm getting conflicting information on this. So I'm going to simplify this for us and give you some specific feedback on IRC code sections and how you should be thinking about passive and non-passive losses and how it applies to your short-term rental income and expenses, and also your depreciation on that asset. So if you look back at some of my previous discussions on my page, you'll see one that goes in depth on passive actively loss rules. I'll do a flyover for this topic and give you some key takeaways. So back in the 80s, Congress had passed a law that basically prevented somebody who was high income earning to be able to go buy a hard asset like real estate and take losses over here in real estate through depreciation and offset all of their income over here, which is essentially what IRS and Congress was taxing. So to prevent this, because essentially if you think about it from Congress's perspective, now, just like any business, they're in the business of creating revenue and cash flow through taxing citizens. To not, this by itself creates a massive reduction in their collections of cash and revenue. So essentially, what was introduced was passive actively loss rules, which essentially say that if you're not a real estate professional, which I can describe, then your losses from real estate will be passive. So the question that's being asked here is the short-term rental passive or is it non-passive? So it essentially depends on two main rules as it relates to short-term rentals alone. Now, if you have a long-term or mid-term rental, I'll talk about that in just a second. But if you have a short-term rental and your average nightly use of the short-term rental is 7 nights or less, essentially you're seen as a hoteling business and you're not not truly long-term rental, mid-term rental, or rental activity. And that's number one, 7 nights or less, average customer use. The second rule is the fact that you are actually materially participating in this activity in the rental. You're managing it, you're hiring the contractors, you're responding to guest requests, you're resolving issues when your guests can't get into the door at 9 p.m. You're solving for the day-to-day issues that come up in that business. And there's 7 tests of material participation. I've previously covered it. You need to meet one of 7 tests. If both are met, the average use of 7 days, 7 nights, and material participation, then you are able to take losses from your short-term rental against all of your income, including your W-2 income and or small business income. Now, if you don't meet those tests, meaning you were having a dip in revenue, so you converted your short-term rental to a mid-term rental or a long-term rental, but nothing else has changed, you're still a W-2 earner, you have high income, then you will have passive losses from short-term rentals. The other use case I see is that you're a physician, you're extremely busy, you're maybe an ER doctor, or you're a highly paid individual in your day job, and you just cannot tend to guest requests in the middle of your workday. You're busy, you're doing your day job. So therefore, you hired a co-host or a property manager. So now you do not materially participate in the rental activity of short-term rentals, and therefore your losses are passive. So can short-term rentals be passive? Non-passive, sorry. Can short-term rentals be non-passive? Yes, as long as you meet the 2 key tests as it relates to short-term rentals. So wanted to clear up that confusion. Now, if you're a W-2 earner with long-term rentals, unfortunately, you're going to have passive losses. And it's not even unfortunate, quote unquote. It depends on what we're trying to accomplish. So maybe in specific years we do want passive losses because you're going to have passive income. So again, it all comes down to, this is a gray area that I was mentioning, where tax planning can really be helpful for you if you're not sure how to structure your assets and how to really maximize your deductions, especially from a depreciation perspective, and how to think about this not only from a 12-month perspective, meaning you don't just want a big refund, you want to position your assets where you're not going to pick up recapture and cap gains in the future. I'm going to answer the question on cost seg in just a minute. The next question I'm going to tackle is, do I need an LLC for my rentals? Also a very common question. And somebody might look at this and say, it's not that simple of an answer. Think about asset protection and think about this and think about that. You're not wrong. I am going to answer this objectively just from a tax perspective. And then I will give you my take on it as an investor, because I also invest in real estate. And I'll give you both sides of the spectrum. So from a tax perspective, the answer is actually no. So if you own if you own a single family home or a multi-family home, and you have tenants in it or short-term rental or any type of real estate, can you own it under your personal name and take all of the tax benefit? Yes. Can you own it in a legal entity, single member LLC, and have all the tax benefits? Also, yes. Can you own it in 2-member LLCs, husband, wife, and have the same tax outcome? Also, yes. The only time you have to look underneath the surface of whether you actively manage it and or whether you qualify to be a real estate professional. Those two sort of are the guiding principles that are going to dictate how your losses from real estate get treated. The legal entity structure really is for asset protection. Do I own my assets inside of legal entities? Yes. Do I own my business inside of a legal entity? Also, yes. So asset protection is a different room in the house than tax planning. They work together. They should work together. But this is misinformation out there where people think that they have to form a legal entity. They bought a house 123 Main Street in their personal names because they were the ones who could qualify for credit for that mortgage. They set up the Rising Sun LLC over here. And unfortunately, all of the business is getting conducted in their personal names, and there's a legal entity over here that doesn't do anything. Maybe collects a K1 from Airbnb or another whatever Stripe or whatever else, wherever income is coming out of, and now you fundamentally have a mismatch and accounting just becomes a mess. So we can streamline this from an entity level planning perspective, and oftentimes work very closely with your attorney and or can recommend you to an attorney who understands real estate, can really help you streamline and clean up your org chart and not have too many different entities that are doing that exist and just cost you money for a tax filing and actually don't give you the legal protection you're looking for, the asset protection. Let me add another question on here because it gets asked also, which is my wife and I own a house together. We own this rental together. Should we be a single member LLC or should we be a two-member LLC? So, again, prefacing this by saying that I'm not an attorney. I cannot speak to asset protection in of itself, but I do want to speak to what happens when one of you wants to sell the asset and the other one doesn't. Maybe perhaps it's not really the situation of a divorce in which, community property rules or your state, intrastate or state rules apply on division of assets. Perhaps it's just one of those things where you want to be able to have rights to whether or not an asset sells in the future or whether or not it becomes part of a 1031 or whether or not it's held in a trust, then in that case, you probably want to be on that legal entity. Perhaps even though it's cheaper for you to do a single member LLC with one member, but if your name is on the mortgage and on the title, perhaps it does make sense to have a two-member LLC where there's two members with equal ownership interests. It's easy to see, or it's not easy. It's predetermined based on an operating agreement how income and expenses will get split up between the two K1s, how distributions will work. You have to treat this as though you were in partnership with an unrelated party, even though this is your spouse, or maybe it's a mother child or son and a dad, or however that partnership structure is set up. Just because it's family does not mean we need to be sloppy on entity level setup and how we actually go through and think through all of the things during peaceful times. Okay, moving on. So the next one on here is the best entity type of flippers. You can also replace flippers with design businesses. Maybe you offer design services or co-hosting, property management. Really think of anything that is a trade or business from an IRS perspective, which is all the things that I mentioned, and is taxed as ordinary income. So flip income, which we have a ton of flippers in our portfolio of clients, flip income is treated as ordinary income. Oftentimes, I'll give you my framework on profitability and when it makes sense to make an S election. A lot of our clients will make the S election. A lot of our clients start out filing Schedule C, small business income, on their tax returns. So here's fundamentally the difference between an S election and a Schedule C reporting. Although they are form names, let me go beneath the surface and go in depth on this to say that a sole proprietorship, Schedule C reporting, or single member LLC, all the same things, different names, is your tax on 100% of the profits from a self-employed tax perspective. So let me give you an example. If your net profit at the end of the day in your small business, Schedule C, single member LLC, was 100,000, you will pay about half of 15.3%. So you'll have the full impact of SE tax. And this is where tax planning comes into play. So if you read a blog, saw a post, or you're watching this and you're wondering whether or not an S-Corp makes sense for you, then I'm going to walk you through three things. Number one, your profit. So if you're less than 50,000 in profit, and it's your first couple years in business, you're just trying to stabilize your business, make sure you can pay yourself, pay all your bills, and take something home, take your target compensation home, then even though it makes sense from a tax planning perspective, it's very likely that you probably should hold off on the S election because I'll walk you through all of the requirements of an S-Corp, and it can be a little bit expensive to set up the S-Corp. So in that vein, you want the tax planning benefit to at least move the needle enough to where it's worth it for you to go set up an S-Corp. So that's number one. Number two would be I'm going to keep going the don't do the S-Corp route first. Number two would be that you're actually planning on dissolving the business. So, for example, talked to a client recently who is doing some software related services, and then she's also doing her co-hosting business. And I asked her, hey, she's making quite a bit of money in her software services business, about 60,000. And I said, what is your plan over the next 3 years? Do you foresee this being a replacement for your full-time income? She just went full-time into her business. And she said, you know what? I actually don't enjoy the software side, the software services I provide. I plan on really bringing on more and more co-hosting clients and really kind of going all in on that side of the business. So my feedback to her was I was going to propose a S election for your software services business, but I anticipate that 60,000 to be 40, then 20, maybe zero over the next several years. So unless you tell me otherwise, meaning you are planning on continuing to perform those services and continue to turn a profit, then we should probably hold off on making that S election, because otherwise you can have an S corp that's making less money year over year. It's actually not moving the tax needle at all. So that's again another con on the S election. The last one would be that you have rental real estate. So if you have rental real estate, which is not flip income, it's not ordinary income, you should not make an S election. Now, when does it make sense to make an S election? So opposites are true as well, which is your years 3 to 5, you're turning about $80,000 to $100,000, or let's say 60,000 plus in profit. My target really is 80 to 100K in profit. You plan on running this business ongoing. You might have other revenue streams that come into play, but the core revenue stream that is produced here, flip income, property management, design services, my firm, professional services. You maybe are a cost segregation firm. Maybe you have a construction business. We have construction businesses that make the S election. Then it does make sense to make an S election. Be mindful, it is a 10-year binding election. You must take reasonable compensation. You must keep clean capital account records. Like accounting becomes important when you're an S corp, and now you actually have to file a business tax return. Your tax compliance fees are probably going to go up because now you have a standalone tax return that needs to be filed, and you need clean records of where your capital account actually sits, so you don't end up kicking out what's called excess distributions, which ends up being a capital gain on your tax return. So there's just more to it, and it's a 10-year binding election, so you want to make sure that you're not just making a decision without thinking through this. All right, let's see. The next one on here that I want to cover is depreciation, right? So a very commonly asked question, which, what is the difference between, you might look at a report, a cost segregation report or otherwise, and you might ask the question and say, well, what is the difference? Maybe I told my cost seg firm it's a long-term rental, now it's a short-term rental. What's the difference? I don't understand. So, or I paid 500,000 and that's not my depreciation. So the way it works is you would look at your purchase price plus your improvements. We would allocate however much so if you paid 500,000 for the asset and about 20% of that, 100,000 is land value, then only 400,000 of that is depreciable basis. For residential real estate, so long-term rentals, mid-term rentals that are not considered commercial property, there's a house that looks like a house, is going to be 27 and a half years of building life that gets depreciated. So essentially, in other words, the simplest way to think about it is a wear and tear on your property, and what the IRS allows for you to take, it's one of the only assets which is real estate, that goes up in value over time, but you can write down on the books and write down on your tax return to take a deduction for it, which is fundamentally how wealth is created in real estate. Commercial properties and short-term rentals are 39-year asset life. So the math on that works differently from a depreciation perspective. Let me pause here and talk about cost segregation studies and what they mean in the simplest way possible. I taught this on one of the trainings for another real estate group, and it really resonated, so I'll repeat it here. So my same example, let's say you bought a house for 500,000. You're buying the house with all the component parts, the roof, the siding, the plumbing, the foundation, even the HVAC unit, even the hot water heater, the bathtub, the the lighting fixtures, the tile. You're buying all the component parts. For depreciation perspective, for you, the buyer who's paying $500,000 for it, cannot, by in any capacity, come in and segregate that asset into how much of that is just foundation, how much of that is just appliances, how you can estimate, but how much of that is just tile, so on and so forth. How much of that is just carpet? You cannot allocate that 500,000 to 30,000 of carpet and 50,000 of foundation and so on and so forth. The reason we would want to segregate this is because IRS has prescribed different asset lives to what they consider will wear and tear quicker than foundation. So for example, foundation is going to be 39-year asset life because they presumably think that foundation will last forever, 39 years, whereas carpet will only last 5 years. So what we do with our clients where it makes sense, once we've overcome and understood, can we take passive actively loss rules and turn them non-passive? Do we meet the test to actually make a material change in this person's tax liability and our client's tax liability? Then we'll propose doing a cost segregation study so we can actually take the loss and take it in the year that we're intending for it to be taken in. The cost seg firm will come and produce a report that takes your $500,000 asset, allocates 100,000 to land, and takes the remaining 400,000 and segregates that into 5-year asset life, 15-year asset life, and the remaining 39-year asset life. I see oftentimes they will take carpet, appliances, some of the fixtures like lighting, curtains, blinds, even plumbing. They'll segregate that to 5 years, then they will go to land improvements, 15 years. Then they will allocate everything else to the building value, which is the longest period of time that cannot be bonus depreciated. We then take the 5 and 15-year asset life and take bonus depreciation on it, which is how you create a tax loss on your tax return that then offsets all of your earned income, W-2 and business income. I'm talking if you either are a real estate professional or if you meet the specific tests I've mentioned before here on this training as it relates to a short-term rental. And that's how you create the substantial amount of either a refund or a net operating loss that can be carried to a future year. If you guys have questions on this and this is confusing, or you want to see if this applies to your specific scenario, then please feel free to reach out to us. We would be more than happy to walk through your specific tax situation and see if we can add numbers to the math we're talking about here. So the deduction for flippers, this is the reason I threw this on here as a slide, is I wanted to walk through what is ordinary and necessary, and then draw a comparison between what is inventory versus what is cost of sales, cost of goods sold in a given year. So anything that directly becomes part of your flip, materials, labor, even staging costs, utilities, these are going to be all cost of sales. Software mileage is going to be usually below the gross profit line. So these are also expenses for tax purposes, but are seen as business expenses. Ordinary necessary is an IRC code section that needs to be highlighted here, right? So for flippers, especially since we serve that market pretty heavily, there is an important distinction between what was inventory at the end of the year versus what went to market and has sold. So for most of our flippers, anything that does not sell between now and year end, which we're coming up on year end, is going to be inventory, even if it's completed and sitting on the market. So if you have houses listed right now that are for sale, unless they sell, and also you're not claiming the income. So you cannot move that inventory from the balance sheet to the profit and loss, recognize the income and the expenses, and either recognize some additional income or a loss. Now, we sometimes have clients who have expensed too much of their inventory and it's not sold yet, in which case their taxable income might be negative, but really some of it belongs in inventory. the opposite is also true. So that means at year end, I'm always looking at the balance sheet and double checking with our flipping clients to say, hey, can you take a look at your balance sheet and make sure that everything that's on the balance sheet has not sold as of year end? Because if something has sold, then we need either positive or negative. Either you have too little income because you made money on a flip, or you have too high of an income and you have not recognized all of your cost of sales. I've also seen situations in which a client has recognized the income from the sale of the asset and they've forgotten to move all of the cost of goods sold. So essentially they've recognized, 300K of top line. That's not what you got for the house. After you paid all of your costs, maybe you only made 30,000 on that flip, but there's a mismatch in expenses, and this common accounting mistake can overstate your taxable income, which is not even a tax planning strategy. It's just basic bookkeeping, but you want somebody who actually knows what they're looking at your books at year end to make sure that you're not missing something super obvious like that. All right, the next one I want to talk about, one of the most common ones I get is, should I buy a vehicle between now and year end to lower my tax burden? Does it need to be a heavy vehicle? Varies entirely by your tax situation. I will keep this a little bit high level because the answer varies substantially between clients. The two things I want to walk you guys through on this is the business use test, super important. The weight test, also very important. And then the differentiation between Section 179 versus bonus depreciation. And the last one, what happens if your usage of the vehicle drops under 50% for business use. So let me tackle the first one first, which is the business use test. So if you buy a vehicle, even if it's in the business's name, but you use it 80% of the time for personal use, then it is not a business deduction. In fact, you should not have bought it in the business's name. And in fact, you probably are taking distributions from your business because you're expensing something in your business books that is personal. It's a personal vehicle used for personal use and therefore not a business deduction. So the use test is fundamental in how you should be thinking about your vehicle. Now, how does IRS keep track of how much, is business versus personal use? Very common for realtors. In the US, we are in a tax system that is a self-assess tax system. Therefore, you are responsible to maintain mileage logs. Most of our clients will use a software called Mile IQ. You can use other software. Nonetheless, it can be paper and pen software or records, doesn't matter. You have to be able to produce your total mileage for the year and then how much of that mileage was business versus personal. In the event of an audit, an auditor is most likely to reclass everything to personal use unless you can prove that you had business usage on this vehicle. That's number one. You cannot depreciate a vehicle that is not over 50, that does not meet the 50% use test for business. So in other words, at a minimum, the usage on your vehicle has to be 50% or greater business use for you to be able to take actual expenses like fuel, repairs, car washes, maintenance on the car, and depreciation, the biggest one. This is why we need to talk before we make the vehicle purchase to make sure we can actually take the deduction we're trying to create with a purchase, especially close to year end. Let me talk about the next one, which is what happens. So let's say you buy it on December 5th today. You watch my live here and you're motivated to go reduce your tax burden. You go out there, you buy a $100,000 truck, and you're like, okay, I'm going to have a $100,000 write-off because I'm essentially going to drive it only for business all of this year. And then I'm going to have this massive deduction on my tax return. That's great. So you took a massive amount of write-off on your truck, $100,000, 100% business use, makes sense. Now come 2026, your usage of that vehicle drops to 20% business and 80% personal. So in this case, unlike real estate, you actually don't have to sell the vehicle for you to create recapture, which essentially is in other words, simple words would be, hey, you took too much of the depreciation. You took 5 years worth of depreciation up front because vehicles are usually a 5-year asset. So you would normally take depreciation over 5 years equally. You took too much in the first year, and so now your usage is dropped. Now you got to recapture that. You have to add back the depreciation you took. So phantom income is what you're adding back to your tax base. So all that to say, you have to meet the usage test year over year. You can't just meet it for 1 month out of the year and take the entirety of the write-off and have no consequence. Now, after 5 years, that's a different conversation that we can have, but those two I wanted to highlight. And then Section 179 applies to a vehicle that does not meet the 6,000 pound weight. The 6,000 pound weight often gets called out in a strategy like this because a heavy vehicle, which is the IRS guidelines on what they consider a heavy vehicle, you can take bonus depreciation, which is exactly what I was describing on $100,000. You can actually take $100,000 of bonus depreciation. Section 179 gets limited at, I don't remember the exact amount off the top of my head, but I want to say right about 30,000. I think it's 31,000 some. Okay, the next one. I think I covered this in some depth, the short-term rental, long-term rental difference. Two things I want to call out on this slide here, just for a little bit of a recap, is short-term rentals asset life is 39 years, long-term rentals are 27 and a half years, and then your opportunity to do tax planning is greatly more favorable for short-term rentals if you have W-2 income. Long-term rentals are almost always going to be passive if you do not meet real estate professional status. So if you have follow-ups on that, please reach out to me. I cover this in much depth just because it's one of the fundamental tax strategies that we use, or at least the fundamental guiding principles when it comes to tax planning. Okay, cost seg, is it worth it? I answered that in another way. I talked about it, or at least I talked about what a cost seg is. Does it make sense? I would say my framework is this, which is your asset expensive enough for there to be a reasonable amount of depreciation that comes through, because these studies are not inexpensive. They're relatively expensive, so you want to make sure the return on it is worthwhile. When do you plan on selling that asset? So if you plan on selling it next year, you're going to have recapture within a 12-month frame. Sometimes it actually can make sense to do a cost seg on it anyways. Reach out to me. There's a specific framework I walk you through, especially if you're high income. Let me throw it out here, just in case somebody is watching this and is like, well, what is that framework? The framework really is, if your effective tax rate is over 25%, the maximum rate at which you recapture income is 25%. So if you're in the 38%, 35% tax bracket, and you can take the cost segregation study this year and reduce your tax burden to recapture it at 25%, you're still recapturing at a much lower rate than you otherwise would be taxed. So in that case, it does make sense. But if you're a taxpayer that normally sits in a 15 to 22% tax bracket and you're planning on selling it next year, then you're just trading tax years. You're going to do the study, take the deduction, and then recapture it in the next year. It just doesn't make a lot of sense unless we look at it a little bit differently, and it, there's something there where it does make sense in your case, but most of the time, I don't think it makes sense if you're selling the asset within a 12 to 18 month time frame. The non-passive, passive bucket of income, meaning what is the cost seg that we're trying to do on the asset underneath it? Do you overcome the passive taxable loss rules? Can you actually take it against your income? Does it make a material change in your effective tax rate downward? Is arguably the most important thing that we have to ask before we go do a cost seg on anything. Basis allocation, meaning this is a very important one, which is if you have an asset that lives on a decent amount of land and the majority of the purchase price was actually land, then maybe it doesn't make sense because the actual outcome is not favorable enough. Another example would be a very positive outcome, right? So maybe you own a condo in Hawaii and you paid $750,000 for the condo, and pretty much the entire purchase price is the building itself because there's no common ownership of the land around it or the common areas. could be a very, very favorable outcome for you if that's your situation. And you can actually take those losses against all your income. And then the last one is I actually just looked at this for one of our clients. We were going to do, excuse me, we were going to do a cost segregation study on 3 assets. And we did the calculations for them here at year end. And it turns out that this is the most low income producing year they've had in a long time. And next year, they have a lot of contracts, they have a lot of inventory on the books. It's all going to hit in the first quarter. They anticipate their earned income to be double what it is this year. So it just doesn't make sense to match up. It just doesn't make sense to take a massive amount of deductions in a year in which you don't have a lot of income. Now, somebody might argue, well, what about loss carryovers? Well, why can't you just create loss carryovers without losing any of the deduction? And that's a fair statement. But if you look at the math on this, their effective tax rate is under 10% this year. They have some organic losses that are coming from previous years, loss carryovers, and also organic depreciation on just their current asset. They have multiple assets that are already in service. It just doesn't make sense to incur the cost right now without knowing what next year looks like, truly. And the last piece of it is there is some added exposure should you take cost segregation study on it this year and the market shifts or something changes and you want to sell any of those 3 assets. Now you feel like you're locked into those 3 assets because you took too much depreciation on it in the most recent year when you didn't actually even need it. Okay, you guys, this is hopefully super helpful. Let's see. I'm actually gonna save this. I have 5 other really awesome slides on this. The entity structure. I'm gonna give you a little bit of a preview. Missed deductions. I think I've got a couple more. The material participation test, we've talked about that, but I can cover it in some detail. And then an actual example of S-Corp, C-Corp. My attempt is to keep these lives under 30 minutes, which I think I'm coming up on the 30 minutes, to really make this impactful and really actionable. So I'm actually going to come back and do another live. I think I'll beef up the rest of the slides with some other common questions that I'm seeing coming through, and really make it super digestible and actionable for you guys next week. So I'm going to pause there and take us to our closing slide here. So if you're looking at this and you have the same type of questions, which is, I have this short-term rental, or I have an insurance business. I'm making money over here. I'm paying so much in taxes. How do I really couple these strategies together to not come up out of pocket on my tax bill? I feel like I'm missing a key planning piece. Or maybe you're just like, hey, I think I left some money on the table the last couple of years. Can somebody just come in and take a look at my last 2 years of tax returns and see if I had any missed opportunities? That's exactly, we do it for free. Actually, the last 2 years, we'll take a look at it. And, frankly, we're not a big fan of amendments unless we really need to amend. Sometimes we absolutely need to amend because there were mistakes, errors, or there's no way to fix mistakes or missed opportunities in the future year, in which case we would recommend an amendment. But essentially, the review is completely free. So if this stands out to you, you feel that we can help you, reach out to us, and we'd be happy to take a look and propose some or come up with the key missed deductions, 3 to 5 missed deductions, and how much was perhaps left on the table from a tax perspective, and or mistakes that either need to be fixed or just changes that should be made in the entity structure going forward. So I hope this was helpful, and I'll see you guys in a week.